In this question, you are being asked to calculate the profit using marginal costing. You've been presented with some budgeted information relating to a manufacturing company, as well as detail regarding the normal level of activity and the profit that has been calculated under absorption costing, which amounts to $36,000. You might recall from your studies that the only difference between marginal and absorption costing is the way in which the inventory is valued. Namely that under absorption costing, inventory unit costs will always include fixed production overheads. Now there is a formula that you can use to calculate the difference between marginal and absorption costing profit, and this is precisely the formula that we are going to use to help us answer this question. The difference between closing and opening inventory multiplied by the overhead absorption rate will always give us the profit difference between the marginal and absorption costing profit. In this question, you have been provided with the absorption costing profit, so let's actually plug that into our equation below. Whilst we are not told what the closing inventory in units are, we can calculate this as the difference between the production units and the sales units, which have been provided. We can clearly see that if production is 14,000 units and the sales that are budgeted in units is 12,000, it must imply that the closing inventory in units must amount to 2,000 units. In the absence of any other information being provided, we can always assume that the opening inventory is nil. So if we can get this down into our equation below, closing inventory 2,000 units, opening inventory is nil. We now need to calculate the OAR. We can work out the OAR from the information provided. The formula to work out the OAR is always going to be the budgeted overhead divided by the budgeted normal level of activity. Now this information is provided in the question. The budgeted overheads have been given as $63,000 and the budgeted normal level of activity has been given as 14,000 units. If we plug this into our calculator, we get $4.5. So we now have the OAR. If we multiply out this bit of our equation, what we get is a profit difference between marginal and absorption costing, which would amount to $9,000. Now, if we want to calculate the marginal costing profit, knowing that the absorption costing profit is $36,000, we simply work backwards to calculate that the marginal costing profit must be the $36,000 less the $9,000. And what that gives us is $27,000. Having calculated this profit, don't forget to include this within your solutions box provided in the question.